Borto. Thank you. You may begin.
Hello, and thank you for joining us. I'm Deborah Borto, Chief of the Presidential Nominations Branch.
And I'm Heather Jones, Senior Counsel for Financial Disclosure.
Patrick, could you please start the slides? The final rule amending 2634 was published on July 18th, 2018. The rule became effective January 1st, 2019. In December, we discussed the changes to confidential financial disclosure as a result of the 2634 changes. Today, we're going to be discussing the changes to public financial disclosure. We issued a legal advisory, LA 18-10, on August 23rd, 2018, which highlighted some of the significant changes to 2634 and included a table that details the changes by regulatory section. On December 4th, 2018, we issued LA 18-15, announcing the release of the revised Public Financial Disclosure Guide and Confidential Financial Disclosure Guide, which outlines the changes to both guides. The 278 guide is located in the Public Financial Disclosure section of our website. Make sure to consult the new guide to ensure you understand the new reporting requirements, particularly with regard to tax-deferred accounts and trusts. So here are some of the highlights of the 278 changes that we will be discussing today. What we believe is the biggest change is that filers now report income that is received rather than income that is received or accrued. The most significant change here is to tax-deferred and tax-advantaged accounts, such as IRAs, defined contribution, and 529 plans. Filers still report the assets that meet the value threshold. That hasn't changed. With respect to sources of income, rather than reporting income when accrued to each asset in the tax-deferred account, income is only reported when distributed. We'll go over some examples of this today. The next substantial change is to the definition of widely diversified in EIF to track the definition of diversified used for exemption purposes in the 2640 regulations. The programmatic items we'll be going over today include early submission of termination reports, filing requirements for individuals who change agencies or branches, certification standards, and the amendment process. I'm going to start by going over specific items that illustrate some of the disclosure changes, and we'll discuss the programmatic changes at the end. So we're not going to be going over every change. We'll be hitting the most common entries. However, the new guide incorporates the changes for each specific entry, and I highly recommend consulting the guide as you familiarize yourself with these changes. Starting with the change to reporting of income, to be consistent with the statute, filers now report income that is received rather than income that is received or accrued. For purposes of financial disclosure, a filer has received income when the filer has the right to exercise control over the income, regardless of whether the filer has taken actual possession. Generally, this means income would be received for purposes of financial disclosure when received for purposes of federal income tax. Note, however, that income would be reportable for financial disclosure purposes, even if it's exempt from federal income tax. I find it easier to understand received in practice rather than in theory. So let's go over a few basic examples. So a filer has received dividends when a stock held, a filer has received dividends on a stock held even if the dividends are reinvested. So that's pretty straightforward. A filer has received a payment for services that has been delivered in the form of a check, even though the filer has not cashed the check. So that's also pretty straightforward. A filer has received his or her share of income from a partnership or LLC, even if all the profit during the reporting period was reinvested in the business. So this one's a little bit trickier and a little bit hard to get your mind around. In partnerships, LLCs, and S-corps, so known as pass-through entities, the income passes through to the owners, whether or not they choose to actually take the cash out of the business. For tax purposes, it is treated as the owner's income, and for financial disclosure purposes, it's also treated as the owner's income. Therefore, the filer reports the income of such a business, whether or not they physically take the cash out of the business. Next item is a pretty common item. A filer has received interest income from a municipal bond, even if the interest is tax exempt. So in these basic examples, the received standard yields the same results as the received or accrued standard would have. So where is the change? Practically speaking, the main place in which the new receipt standard will affect filers is in the treatment of tax-deferred plans and accounts. OGE does not treat tax-deferred income accruing within a retirement plan or account as having been received. The filer, however, would report distributions as having been received. So let's look at how the changes to income reporting affect IRAs, 529 plans, and defined contribution plans. Under the previous requirements, filers would report each underlying asset that ended the reporting period with a value of more than $1,000, and each underlying asset that produced more than 200 in accrued income during the reporting period. Now filers continue to report each underlying asset that ended the reporting period with a value of more than $1,000. That hasn't changed. What has changed is how income is reported. Instead of trying to attach the tax-deferred income to the assets in the account, which for the most part filers have been unable to calculate, filers now identify the income for the assets in the account as none or less than 201 and report income when it is received at distribution. So taking a look at this example, here's how a filer might report an IRA with reportable underlying assets. In this case, the filer has not received a distribution. The filer has reported each underlying asset that ended the reporting period with a value of greater than $1,000 and has identified the appropriate value category. The filer does not report income that is accrued and has identified income as none or less than $201, as you can see in yellow. Now let's look at two examples where a filer is getting distributions from an IRA account. In the first example, the account holds assets with a value of over $1,000, and those assets are reported. Again, the income accrued to those assets is not reported, and income is marked as none or less than 201 for the underlying assets. So take, for example, ABC Diversified Bond Fund with a value reported and income of none or less than $201. However, in this case, the filer has received a distribution during the reporting period, and that's reported in line 1 in the exact amount. In the second example on this slide, the filer has received a final distribution from an IRA account, and there are no assets remaining in the account. Therefore, the only item to report here is the amount of cash distribution. It is helpful in this case to identify that there are no remaining assets in the account, as is done in this example. All three of these examples are in our financial disclosure guide. So as you can see, this change has made things much easier. Filers previously found it challenging to determine the accrued income for assets held in tax-deferred accounts. That determination is no longer required. They simply mark none or less than $201 for each underlying asset and report income at the distribution phase. Now, you probably will have some annual filers following the old method, and you will have to let them know that they no longer need to try to figure out the accrued income. In the interest of time, we will not go through all the different tax-deferred interests that a filer might have, but a similar logic applies. I would recommend reviewing those entries in the revised Public Financial Disclosure Guide. For many of the tax-deferred accounts, like IRAs and 401ks, most of your filers will not be in the distribution phase yet and will not have a cash distribution to report until they are of retirement age. However, your filers may be in the distribution phase of a 529 plan because their kids are in college, in which case, in addition to reporting assets still held in the plan, they would report the cash distribution. Again, there are examples of this in our guide. While we were updating the guide, we took the opportunity to clarify a few items. For example, The new guide clarifies that a good faith estimate for value should only be used if the filer can't obtain the exact value of an asset without undue hardship or expense. This means if there is a market value, you should be using that figure for valuation. For example, for publicly traded stock, the exchange value should be used. Value not readily ascertainable can be used if a good faith estimate is not possible, but keep in mind, when a value is not ascertainable, filers may need to provide additional details in lieu of a value estimate, as they do in the case of stock options. With respect to operating businesses, an estimate generally should be possible, and for nominees, OGE will push back on allowing value not readily ascertainable for operating businesses. Let's go to the next slide and talk about a change to the criteria for widely diversified with respect to accepted investment funds. For pooled investment funds that are not publicly traded or available, they have to be widely diversified in order to qualify as an accepted investment fund, an EIF. Although there are other elements to the EIF determination, we will be focusing on the definition of widely diversified because that's where we made the change. The previous criterion in 2634 for widely diversified was complicated and very difficult to meet. The new criterion brings the widely diversified definition in 2634 in line with the definition of diversified that's found in 2640, which, as you know, is far less complicated. The previous definition required a calculation that was not easy to apply because fund managers would generally not be willing to do that calculation or not willing to provide the data necessary for an ethics official to do that calculation. With the new definition of diversified, it's a matter of determining that the fund does not have a stated policy of concentrating its investments in any industry, business, or single country other than the United States, or bonds of a single state within the United States. Please keep in mind that even with this change to bring the definition of diversified for EIF in line with the definition of diversified in 2640, not every EIF qualifies for the 2640 exemptions. A fund that does not meet the definition of mutual fund or unit investment trust will not qualify for the mutual fund or unit investment trust exemptions. In other words, the basket of funds that qualify as EIF is larger than the basket of funds that are exempt. So to sum it up, we have simplified the reporting, but you still need to assess whether or not the fund qualifies for a regulatory exemption. So let's look at an example here, comparing the old definition of widely diversified to the new. A filer holds an investment fund through a defined contribution plan. The fund is not publicly traded or available, which is why we are now looking to see if it is widely diversified. The fund has 7% of its value from one asset. The fund has a policy of investing in a variety of economic sectors. With the previous definition, the fund would not have been an EIF because it is not publicly traded or available and would not have been widely diversified because more than 5% is in one issuer. So it would have failed the widely diversified test. With the new definition, the percentage in issuers and sectors does not matter. You are no longer doing that calculation. You are looking at the stated policy. Because the fund has a policy of investing in a variety of economic sectors, it is now widely diversified. I'm going to now turn it over to Heather to go over some additional reporting items and some programmatic items. Thank you.
When we revised the regulation, OGE made a subtle change to the termination reporting period to bring it in line with the statute, to bring the regulation in line with the statute. You may not actually notice the difference, so we want to explain how it will work with a filer. If a filer terminates, a public filer terminates their position before May 15th or before they file their annual report, the termination report will cover the previous calendar year and this calendar year to the termination date. If the public filer terminates after May 15th or after filing their annual financial disclosure report, it will cover January 1st of this year through the termination date. We also made some changes to identifying beneficial interests in irrevocable trust. In this case, we're talking about the beneficial interest in the trust, not about the trustee positions. If a filer, spouse, or dependent child currently has a right to receive the income or access the principal of the trust. For example, they do not have to wait for something to happen, like someone dying, before they can access the income or principal. We say that they have a current right, even if the circumstances are limited in which they can exercise that right. For example, if they can only access the income or principal of the trust to pay for education or to pay for health care. In that case, even in those limited circumstances, if they have that current right, the assets of the trust must be reported on the financial disclosure report. If the filer, the spouse, or dependent child have a future interest in the trust, in that case, something needs to happen before their interest is current, like someone dying, then the assets will go on the report only if that interest is vested under state law. Ethics officials should not be making the vested determination under state law. We believe filers should consult with the trustee or with a lawyer who created a trust or a trust lawyer who can review the document for them and let them know whether they have a vested beneficial interest. We also made a change to the regulation regarding transactions to codify a practice that was already taking place. An employee is not required to report any transaction or file a transaction report, a 278T, for any transaction before they entered a public filing position, nor do they have to report any transaction or file a transaction report, a 278T, for the period before they became a federal employee. This slide illustrates two examples of an employee who's moving into and out of a public filing position. In the first case, the filer would not report the transaction because it was executed before the filer entered the public filing position. In the second case, the filer would report the transaction because it was executed while the filer was still in the public filing position, even if they happen to file the transaction report after they leave the filing position. One more example for you that isn't on the slide: if the filer bought the ABC stock on April the 5th and then became a federal employee in a public filing position on April 15th, they would not report that transaction on either a 278T or on their annual report. OGE has simplified the rules regarding which tickets to events must be reported as gifts on the gift schedule of the public financial disclosure report. The rule is, if the filer receives a ticket to an event as a gift, the amount of the gift is the face value on the ticket. Filers may no longer subtract the value of food and beverages from the face value to avoid reporting attendance at an event on the financial disclosure report. We're now going to move forward to discuss some of the programmatic changes. That wraps up our discussion of changes to the reporting requirements. There is an exclusion in both the statute and the regulation for certain Schedule C filers from having to do public financial disclosure reports. We have revised the regulation so that the DAO may now exclude positions that are GS 13 or lower from filing a public financial disclosure report without requesting OGE approval. In order to do this, the DAO must make a written determination that there is no substantial policymaking role for the position. As noted in the example, this typically will be for employees who serve in roles like a scheduler or assistant or other non-policy making positions. We also made changes to termination filing in the sense that we have provided for early termination filing, and we wanted to point out the changes to the guide, which were announced in a legal advisory that we issued last year when people move from one public filing position to another. We now allow termination reports to be filed up to 15 days prior to the termination date if the filer agrees to update the report if there are any changes after the report is filed. Common instances where this may happen would be if the filer bought a new asset or if they made an arrangement to take a position. Those would need to be reported to the ethics official, who can then make an annotation on the report updating the report. We also have created an option in integrity called an early termination filing that will allow you to do the filing up to 15 days before the termination date. Previously, integrity did not allow filers to have that option. Also, we want to remind you to collect reports from filers who worked more than 60 days in a public filing position in 2018, even if that work was not at your agency. A filer is legally required to file under the statute, and they are directed by the statute to file at the agency where they are working on the filing date of May 15th, unless they already filed an annual report at their former agency. But if they have already filed a report, you should ask for a copy when they start with you as a best practice. This rule applies for someone who moved from one executive branch agency to another executive branch agency, but it also applies if someone moved to an executive branch agency from either the judicial branch or the legislative branch. We made some changes to the review and certification standards in the regulations. We added that the review by the ethics official should include an assessment that the filer is currently in compliance with all applicable executive orders regarding ethics, such as the current ethics pledge. Also, we set a deadline for filers providing information back to the ethics official that's requested in order to complete the review of the report. If additional information is needed from a filer, the ethics official must contact the filer within 60 days of receipt of the 278, and then the filer has no more than 30 days to respond. You can make the deadline shorter, but you cannot make it longer than 30 days. This is a hard deadline that cannot be extended without a written extension, giving them more than the 30 days. An email is okay to provide that written extension. Agencies also may now amend reports after certification, but they must do so in the same manner as they annotate reports prior to certification. Please note, however, that the report needs to make clear that the amendment that was added meets the criteria for certification as well as the original certified report. OGE is also now allowing DAOs to approve the use of brokerage statements or other attachments for reports that do not come to OGE. Reports that come to OGE, PS filers, and DAOs must have that approved by the director of OGE. The statement or attachment must include all the information that is required on the 278 form. The information must be presented in a clear and concise fashion, and it must cover the reporting period completely. I encourage you to consult with the online guide for public financial disclosure if you have a question. I do it a lot, even though my every day is filled with financial disclosure. I do it for assets that I don't see very often to make sure that I'm right about what the reporting should be. And I encourage you to do that as well. I also want to make a pitch for the conflicts of interest guidance that's available on our website and under the topics tab. It's a great resource to highlight the ethics issues that you may need to think through with respect to a particular type of asset. I also look at this guidance if I'm looking at an asset that I don't think about very often to make sure that I am catching all of the ethics issues that are attached to that asset. I'd like to thank you very much for joining us today. We're happy to take your questions at this point. And Lisa, we're ready to take questions.
Thank you. We will now begin the question and answer session. If you would like to ask a question, please press star 1. To withdraw your request, press star 2. Please unmute your phone and record your name clearly when prompted. Your name is required to introduce your question. And to ask a question, please press star 1. At this time, I show no questions. One moment, please. One question did come up. One moment for the first question. First question comes from Michael Kazi. You may ask your question.
Thank you. I was wondering, so if an employee, assuming there's DAO approval, if an employee files a brokerage statement, does that mean that they are not required to produce the same information on the 278 itself?
So again, as Heather pointed out, with respect to if we're talking about a nominee financial disclosure, OGE does not allow brokerage statements. We do leave it up to the ethics official with respect to whether or not they're going to accept a brokerage statement. There should be on the financial disclosure report itself some sort of reference to that statement. So, for example, if an account is broken out in a brokerage statement, a line item on the financial disclosure report would identify that and then reference the brokerage statement. And again, the brokerage statement would need to cover all the information that would be covered on the report itself.
Thank you.
At this time, I show no questions. As a reminder, if you have a question, please press star 1. The next question comes from Jim Heaton.
Yes, thank you. I have a clarification question on termination reports. I thought I heard that one of the new changes is that if termination, such as a retirement, is after the 15th of May, the termination report should cover the calendar year. Previously, you used to be able to do a combination annual and termination report that extended beyond May 15th. And I just wanted clarification of that. One of our general officers is retiring June 1st, so it's just a couple of weeks after 15 May, but just want to make sure I give the right advice on, an annual report, whether or not an annual report is still due in addition to a termination report that would cover the calendar year, or if the termination is after 15 May, whether there has to be 2 reports.
So he would need to get an extension. And if he received that extension, then he could do the combination report. But if he doesn't get an extension, he'll have to do both.
Okay, so the combination report is still possible even if the termination is after 15 May.
Yes, as long as you're within.
Provided
provided they have the extension.
Okay, good. Thank you. That's consistent with the advice I gave. So I
Yes.
thought I misinterpreted the comment in the opening discussion.
Yeah,
Thank
we
you
were
very
just trying to keep it simple, but yes, that still works.
The next question comes from Demona Cohen. You can ask your question.
I had a question about the amending reports after certification, and I guess whether it's increased functionality and integrity, and whether the filer can make the amendments, or if it has to be the ethics official.
So I don't believe there is a current plan to change the functionality and integrity to add for amendments. So once the report is certified by the agency, it will be locked in a sense. And you actually cannot make the change in integrity. So you would likely need to make the change on the PDF version and add it so that it's the one that's publicly provided to people. I don't know if Deb has anything else to add.
Yeah, and with respect to amendments, if we're talking about a nominee, a PAS, you would be working with OGE on that. You should contact the reviewer who you worked with on the original report, and they'll walk you through it and provide some examples of how to do an amendment. But it wouldn't be an amendment to the actual report. There would be some additional pages in the form of a letter or additional pages that would then be attached to the report.
The next question comes from Robin Gold.
Hi, yeah, I needed a clarification on the slide with IFs, the market value of the ticket. You say that the market value of the ticket is equal to the value of the ticket, and then you say in the example that it's the face value of the ticket. So what about if the market value is not the face value?
So the question was, what if the market value isn't the face value? We consider the face value of the ticket to be the market value of the ticket. We consider that to be one and the same.
Okay, even if you know that tickets are going for much more than what the face value is, you still consider it to be the face value?
Like on a
That's what we consider it to be.
so the question is, if you know the tickets are going for much more, like on a, I assume like on a secondary market. Yeah, what the types of the events we're talking about are generally not sporting events, but more like the correspondence dinner or the some sort of fancy charity event in Washington, D.C. So in those cases, it would be the face value of the ticket for that type of event with food and beverage.
Okay, but what if it is a sporting event that they got a ticket to? Well, we know that the face value is not the value.
We know that someone purchased it for more than the face value. The regulation says the regulation says the market value. You use the market value of the ticket.
Okay, thank you.
The next question comes from Michael Rosenthal.
Hi, question about the clarification on the widely diversified definition. Under the new definition, Am I correct that the, in order to be an EIF, the fund does not need to be publicly traded?
Right. So there are several prongs to the EIF definition. One is that it needs to be widely held. One, that you can't exercise control over the fund. And then the third one, it needs to meet one of these. So it either needs to be publicly traded, publicly available, or widely diversified. We didn't go over all of the elements because the change here was to widely diversified. If a fund is publicly traded or publicly available, then you don't have to worry about looking at the widely diversified.
Okay. Thank you.
Thank you.
At this time, I show no further questions.
Okay.
As a reminder, if you have a question, please press star one.
Okay, it sounds like we have no further questions. Thank you for joining us today. And again, a reminder, please consult the guides as you familiarize yourself with the new guidance. Thank you.